Ladies and gentlemen, welcome to TradAfrica. My name is Simon Ngon. Last week, we promised to talk about different ways of approaching the market. Today, we're going to talk about three ways or three types of trading: day trading, swing trading, and investment. Let's start with the day trading. What really is day trading? Day trading is buying and selling a quantity of security within a second, minute, or mostly within the same day, but not overnight position. Although a swing trader will seek to capture short-term gain over a period of days, weeks, or months, but not exceeding a year. However, what makes those two types of trading different from the investment? In other words, what is the difference between investment and trading? Well, investors usually think more about long-term holding. They're going to buy something and hold onto it from many months to many years. They're looking for capital appreciation. They want the price to go up of their investment, but they also think about yield. What kind of dividends or return they are earning on their investment. Finally, investors like diversification. They don't want to put all their eggs into one basket. They want to spread those eggs. On the other hand, traders think a little bit differently. They think in terms of short term. They may be holding a position for seconds, minutes, hours, days, even weeks or months, but not for years like investor. They are also very practical on managing risk. What does that mean? If you were to take an example of $60,000 account, investors might split this up into 10 pieces, 10% each, $6,000 a piece, and then they look to hold long-term position on each one of those. Traders, on the other hand, might think in terms of risking just 1% of their equity on each trade. That translates into a $600 per trade. Again, they are looking at short holding period, second, minute, hours, even days or weeks. But typically, they are not thinking in terms of years like an investor would. Using that example, here is one way that an investor might split up his money into 10 different pieces of $6,000 each. They got 10 different symbols for 10 different stocks that they are holding. But what the trader going to do? The traders going to look at trade by trade, risking $600 on each trade. That was 1% of that $60,000. And these are short-term investment. This means that day trader will go in and out of the trade, risking 1% of his equity and managing the risk. What about the swing trader? The first trade was only 10 days long and the allocation was $10,000. So he may use up a large portion of his equity for any individual trade. But because he's holding it for a short term and because he is managing risk, it's not a big deal for him. The second trade lasted 5 days. And in this case, that trader used up to 30,000 of his equity. The third trade also ran out to about 21 days. And he have an allocation of $20,000. So the amount of money that the trader put into the position is not what they're managing. Unlike an investor, a trader is managing that risk. That $600 is what they're concerned about. So, positions are worth more at the end of the trade than they were at the beginning of the trade. If they buy something and it goes up in price and then they sell, they make money in that trade because prices vary. But if the trade goes to the wrong direction and they lost the $600, they're out of the trade. Because prices don't always do what traders want, there is always the risk of loss. But good traders manage their risk. They keep those losses small and they try to get the gain as large as possible. At this point, let's recap, ladies and gentlemen, what we learned in this chapter. During this lesson, we talked about three different types of trading: day trading, swing trading, and investment. The difference between them is that in day trading, one trade can only last a second, a minute, or a day, but not overnight position. Swing trading, in the other hand, can take an overnight position and keep it to days, weeks, or months, but not more than a year. About investment, investors usually think more about long-term holding. They're going to buy something and hold onto it for many months or many years because they are looking for capital appreciation or dividend on the investment. Now the question is, ladies and gentlemen, what kind of trader do you want to be? A day trader, a swing trader, or investor? The answer is yours, depending on your objective or your schedule. Most people start with swing trading because they don't have enough time to day trade. Maybe their job or situation doesn't allow them. But if you have time, you can day trade depending on your schedule or become an investor. Nevertheless, the courses we provide here at TradAfrica will be useful whether you are a day trader, swing trader, or investor. For me particularly, I am a day trader because I mostly trade during a day. Next week, we will talk about the tools you will need to start trading. We invite you again for our upcoming lesson at TradAfrica. Thank you for your attention and goodbye.